Trump just threatened 150 countries with a tariff ultimatum: pay up or get out. But within days, markets crashed. Allies ghosted him, and even Walmart warned, "We can't survive this." Behind the scenes, his own advisors scrambled to pause the chaos. No deals, no leverage, just a global revolt against U.S. trade. And now the bluff that was supposed to make America strong might be the move that breaks it. Stay with this, because what comes next is even worse. What do you call it when the world's largest economy starts mailing tariff bills like parking tickets? On May 17th, President Donald Trump announced that 150 countries would soon receive letters, not trade offers, not diplomatic outreach, but flat-rate tariff demands. According to his remarks in Abu Dhabi, these letters would come from Treasury Secretary Scott Bessent and Commerce Secretary Howard Lutnick, instructing governments on what they'll be paying to do business in the United States. The problem: no country had agreed to these terms. And as Bloomberg reported the same week, even key U.S. allies were blindsided by the abrupt shift. Trump's rationale, "It's not possible to meet with everyone," masked the reality. His administration was overwhelmed, behind schedule, and facing backlash after his April 2nd tariff rollout sent global markets reeling. Within days, the S&P 500 plunged 5.3%, wiping out $1.8 trillion in equity, according to WSJ. Instead of diplomacy, Trump resorted to dictation. But the idea that tariffs could be imposed unilaterally on 150 nations without formal negotiations, that wasn't strength. That was desperation disguised as strategy. And what those letters triggered next wasn't compliance, it was confrontation. There's a difference between negotiating a trade deal and issuing a bill, and Trump's letter campaign blurred that line beyond recognition. On May 18th, Reuters confirmed that no countries had officially received these letters yet, and White House aides privately admitted the letters were a placeholder for talks that never materialized. According to former U.S. Trade Representative Susan Schwab, there is no legal mechanism for unilaterally setting tariff rates by memo. This isn't how international trade works. Yet Trump insisted they'd be very fair. What he didn't say is that tariffs function as import taxes, and those taxes are paid not by governments abroad, but by American businesses here at home. A 2024 CBO analysis found that 92% of tariff costs levied under Trump's prior trade war were absorbed domestically, not by foreign exporters. The April tariffs raised baseline rates to 10%, with punitive rates hitting 50% on targeted countries. And as the Wall Street Journal reported, these increases disproportionately hit sectors like retail, construction, and manufacturing, many of which are still recovering from pandemic-era disruptions. The letter strategy wasn't about policy. It was a collection notice, and the cost was stamped "Made in America." When Trump enacted his first wave of tariffs in April 2025, he called it Liberation Day. But honestly, the only thing liberated was volatility. The U.S. imposed baseline tariffs of 10% across all imports, with reciprocal penalties up to 50% on 60 countries. Yet within weeks, not a single trade agreement had been finalized, and key partners, including Japan, South Korea, and the European Union, began stalling negotiations altogether. According to a May 2025 IMF report, global trade volumes contracted by 1.6% in April alone, marking the steepest monthly decline since early COVID disruptions. At home, inflation surged. The Bureau of Labor Statistics reported a 0.7% rise in core consumer prices in April, with sharp increases in clothing, electronics, and household goods directly linked to tariff pass-throughs. Walmart, in a May 10th earnings call, warned of price hikes across 8,000 product lines, and directly attributed the jump to increased import costs from China and Mexico. And yet, despite the inflationary spike, Trump's team continued to insist that deals are coming. White House spokesman Kush Desai claimed on May 12th that quick action is restoring American greatness. But no signed agreements had been announced. Instead, what followed was capital flight consumer anxiety and rising calls from economists like Mark Zandi of Moody's Analytics, who said, "This tariff wave looks more like economic malpractice than negotiation." But the fallout didn't stop there. Trump promised a whirlwind of trade wins, 90 deals in 90 days, but nearly 3 months in the actual count is 0 signed agreements. The only document publicly acknowledged a supposed deal with the UK ends with a single line that invalidates the headline. This document does not constitute a legally binding agreement. That came directly from the agreement text obtained by Reuters. Meanwhile, negotiations with South Korea and Japan, touted as nearly complete, have stalled over tariff clarity and enforcement rules, according to diplomatic sources cited in Bloomberg. Even China, once labeled eager by the administration, has only agreed to continue discussions. No timelines, no terms. Just a handshake and a photo op. The disconnect between rhetoric and results is not subtle. On May 14th, Commerce Secretary Howard Lutnick claimed, "We're locking in results faster than at any time in recent trade history." But Federal Reserve data released 2 days later showed a 2.1% contraction in U.S. export volumes in Q2, wiping out any benefit from the promised deals. Trump's deal count remains as fictional as the timeline, and that gap between press conferences and paperwork, it's widening fast. The political theater of trade policy played well on stage, but at street level, it bled wallets. According to the University of Michigan's May 2025 Consumer Sentiment Survey, 74% of respondents spontaneously mentioned tariffs as a source of inflation stress, up from 58% just 1 month earlier. The National Federation of Independent Business reported that 42% of small firms postponed investments in April due to tariff uncertainty. Walmart stated in its Q2 guidance that prices on imported goods would rise 5.15% depending on the product category, specifically citing increased costs from China, India, and Mexico. Target followed with a public statement warning of across-the-board price increases in electronics, furniture, and textiles. And while large chains could cushion the blow, smaller retailers were cornered, either raise prices or cut staff. In rural areas, where margins are tighter, some stores simply shut down. According to the U.S. Chamber of Commerce, over 1,300 small businesses filed for Chapter 11 bankruptcy in April, alone, up 23% from the same period last year. These weren't just numbers. They were lives rerouted by policy misfires. And for every politician insisting the American worker comes first, there's a shop owner forced to explain to customers why a basic blender now costs 20% more than last spring. So when Trump said the country was winning on trade, it was unclear who he meant, because it wasn't the people paying at the register. What happens when the world's largest economy replaces policy with poker? In May 2025, Treasury Secretary Scott Bessent defended Trump's unpredictable tariff shifts as strategic uncertainty, arguing on CNN that ambiguity would prevent other countries from playing us in negotiations. But data suggests it was American businesses, not foreign rivals, getting played. According to Bloomberg, economics capital expenditures by U.S. manufacturers fell 11% month over month in April, the steepest drop since early pandemic shutdowns. The National Federation of Independent Business reported that 38% of small firms froze hiring entirely citing tariff instability. This wasn't strategic leverage. It was policy paralysis. Businesses couldn't forecast costs, retailers couldn't plan inventories, and exporters couldn't sign contracts with confidence. A McKinsey Global Institute survey released May 15th showed that 62% of U.S. CEOs delayed major investment decisions directly due to fluctuating tariff guidance. Instead of tightening the screws on adversaries, Trump's strategy stalled domestic growth, triggering what economists now call a self-imposed economic chill. But the most chilling part, it was just the beginning of the damage. Trump didn't just raise tariffs. He built a compound interest machine for inflation. According to the U.S. International Trade Commission, the average effective tariff rate under Trump's new plan rose to 38% when combining his new 30% layer with the historical baseline of 8%. These weren't symbolic numbers. The National Retail Federation reported that cost increases passed down to consumers pushed average prices on imported apparel up 19%, electronics 12%, and home goods 14% in April alone. A cotton hoodie made in Bangladesh now costs $7 more at checkout. A microwave from Shenzhen, $28 higher. According to Oxford Economics, the 2025 tariff spike could erase $128 billion in GDP if sustained through the third quarter. Even Walmart, the largest U.S. retailer, warned in its May earnings call that price hikes would be structural, not temporary, citing direct supplier cost surges in over 6,000 product lines. While Trump claimed this would level the field, the real balance sheet shows American families footing the bill with no evidence of reciprocal tariff cuts from foreign governments. This isn't economic leverage. It's a silent tax at the cash register, and the cost curve is still rising. On April 15th, following a brutal week that saw the S&P 500 drop 5.3% and the Dow lose 1,700 points, Trump reversed course and announced a 90-day pause on the majority of new tariffs excluding China. But behind the pause was panic. According to a leaked Treasury memo reviewed by Reuters, internal modeling showed that continuing the April tariff trajectory could push core inflation past 5% by July and strip $200 billion from annual consumer spending. Major firms were already in crisis mode. Home Depot canceled $60 million in appliance orders. General Electric froze a planned expansion in Indiana. And the U.S. Chamber of Commerce issued a rare public warning that trade uncertainty was actively destabilizing capital flows. Trump publicly reframed the retreat as tactical. "We wanted bargaining power," he said. But power implies control. And what unfolded was a retreat under fire. The tariffs didn't bring nations to the table. They brought Wall Street to the brink. And even the 90-day delay offered little clarity, because the White House also warned if countries didn't negotiate in good faith, the 50% reciprocal tariffs would snap back. The only thing certain was more chaos ahead. The bluff didn't break foreign economies. It broke American credibility. Former National Economic Council Director Gary Cohn said flatly in a May 2025 interview with CNBC, Trump misunderstood tariffs. He believed foreign governments pay them. They don't. U.S. businesses do. That misunderstanding was mirrored on the global stage. Rather than rushing to strike deals, key trading partners simply waited Trump out. The EU issued no formal response to the letters. Japan paused negotiations. Canada instead deepened ties with China, finalizing a $14.2 billion liquefied natural gas deal. Beijing had originally pitched to Washington. According to the Financial Times, even longtime U.S. allies grew wary of Washington's volatility, with French Finance Minister Bruno Le Maire stating, "We need stable partners, not shifting terms on demand." The bluff failed because it lacked leverage. While Trump believed unpredictability was strength, others saw it as weakness. Markets adapt, governments plan. And when the world saw no consistency behind the threats, they chose to ignore them. The irony: the only ones still playing the game were the ones Trump claimed he was protecting. American companies watching demand drop and costs rise, waiting for relief that never came.